Now, that video here shows you a way on how to use option prices to compute a variance forecast in a model-free way. So I basically show you here how to compute what we call a Q variance in a model-free way. And to be precise, it's a way to compute the term structure of expected Q variance. And said differently, we will now talk about the VIX, or to be more precise, VIX to the power of 2. Now, the VIX has been talked about in any financial newspaper during the financial crisis. It had also been termed the fear index. So the goal of this video is to provide you with an introduction into what the VIX really stands for. Notice, now that we have to dig deeper into financial concepts, it becomes harder and harder to ship around more advanced concepts like stochastic calculus and the stochastic discount factor approach to pricing. I will try not to rely on these concepts in that video here, yet from time to time you will notice that to go any further, you do need at least a basic understanding of stochastic calculus and the SDF pricing framework. So let's start. Let's assume the following three assumptions hold for all time periods little t that goes from 0 to capital T. Assumption 1. The continuously compounded risk-free rate is constant and denoted as R. Assumption 2. The asset of consideration pays no dividends within the time period, 0 capital T. And the third assumption is let ST be the time t price of an asset. ST is assumed to follow a diffusive Ito process, meaning there are no discontinuous jumps in the underlying price. So let's introduce a special contract on ST, namely a variance swap. A variance swap is an agreement as of today, which we denote as t equals 0, to exchange the sum of realized squared daily log returns up to maturity capital T. So mathematically, that is the payoff that we exchange, where the delta is, in most contracts, 1 day. Now, it's market convention to make the contract such that no money exchanges hands at initialization of the trade. Now, as a result, based on no arbitrage pricing theory, the time t0 fair value of that swap equals V tilde. And one can show that it coincides with the expected value of all future squared daily log returns, as in the next expression, where very importantly, the expectation is calculated under the risk-neutral probability measure Q. Note, so far in the course, we haven't talked about risk-neutral pricing. I will not explain that concept in that video here, as it takes at least 1 hour to do so. Instead, take that again as a motivation that we really need to spend some time later on to dive deeper into the theory of asset pricing. But for now, we go with what we have. So notice the important takeaway. The VIX to the power of 2 that you hear and read about. Of course, you just read or hear about the VIX itself. But here in my video, everything is basically in terms of VIX to the power of 2. Now, that information, so VIX to the power 2, is simply the price of a variance swap that's written on the S&P 500. Now, similarly, when you hear about the V stocks, or here more precise, the V stocks to the power of 2, That is simply the market price of a variance swap that is written on the Euro Stoxx 50. So that's why these measures are price measures of variance as it's priced in the option market. Now also note, as you vary maturity capital T, you can trace out a full term structure of expected priced in Q variance. Now let's turn to some math. Let F0 capital T be the time T0 value of a futures that is written on S and that has maturity capital T. One could prove that if assumptions A1, A2 and A3 hold, and if the delta, the time increment, goes to 0, then V tilde takes that particular solution which you now see, where P0T of K is the time T value of a put option written on S that has maturity capital T and a strike level of K. Now similarly, C0T of K is the time 0 value of a call option written on S that has maturity capital T and strike K. Now the first time you see that formula, you just want to leave the room. Now the more often you look at the formula, the more convenience you obtain with advanced financial theory, the more pleasurable it will be to look at the formula. Now, on an intuitive level, what it really tells you is that the market's forecast of the variance over the next capital T periods can be read off current option prices. You simply need a cross-section, meaning you need different put and call prices for different Ks, that's the cross-section of a given day. You build the average according to that integral representation and you get your variance forecast. No time series methods necessary, no measurement errors, no model assumptions besides these assumptions A1 to A3. Now if you look at the weighting, you see that each put and call option is weighted by 1 over K square. So the smaller the K, the larger 1 over K square, so the larger the weight of the option in that contract for the vol estimate. Now let's move on a little bit. Now the above expression for V tilde does coincide with the expected integrated diffusive variance, where again we talk here about the risk neutral expectation. So in other words, that says that VIX to the power of 2 with maturity capital T is calculated according to the last equation. And that also coincides with the expectation under Q of the integrated variance calculated as the integral from 0 to t of sigma t squared dt, where sigma t is the diffusive conditional variance of the underlying. Now let's stay with that last equation here with the integrated variance for another minute. So look at what we have here. We have V tilde, which stands for the expected integrated variance from today up to capital T. Now the expectation is taken under the risk neutral pricing measure Q. Simplistically speaking, that simply says that the expected variance from today up to capital T, which is priced into the option contracts today, is that V tilde. So as you continue to look at each ingredient of the formula, you might wonder what I've mentioned before. Why isn't there any backward-looking time series data involved? Well, that is exactly the beauty of option-priced implied variance forecasts. All you need is the selection of today's option prices which mature at the horizon for which you want the volatility forecast. And then you aggregate the respective option prices and you receive your forward-looking forecast for future variance. If you watched my video on getting the p-variance with the Corsi 2009 method, you would now have two measures at hand for forward-looking integrated diffusive variance. Now the Corsi method is a time series method that gives you the p-variance. VIX to the power of 2, calculated using the second last equation from above, is a forward-looking measure for Q variance. And the spread of both will be called the variance risk premium, which is a risk premium for having systematic variance risk in your portfolio. Now I can see that this video opened more questions than it closed. That is because it tells us we need a better understanding of advanced asset pricing concepts. And I plan to post a couple of videos to bring you up to speed on these topics.